cooked in the short term here. Money keeps on rotating around, and what we really call that is Wyckoff distribution. What's happening is it seems like every week there is a new sector or theme that is running hot. But then the next week, they're getting just absolutely demolished. And we just have continued to see this, and we've continued to see this choppiness in the market since the big run up since April. And in today's video, I want to go over some things that I'm seeing in the market that remind me of 2025 before the tariff get-in, and earlier this year in 2026 before the Iran war caused a correction this year in the markets. So we're going to be talking about that. We're going to be talking about what I'm seeing on my indicators and how it's repeating. The history is repeating. And we're also going to be talking about some news to go along with why we think this is going to happen. And we're going to be looking at the options market and the dealer's positioning to see what the options are telling us where we could possibly go over the next few weeks to months. So let's just jump right into it, guys. I appreciate you being here. All I ask is you hit that like button, hit the subscribe button, and hit the notification bell if you want to stay up to date on markets, trades, and everything else we're doing over here. Ronnie V Trades. Also, if you want access to the investing or trading collective, I'll leave that link down in the bio below. So let's just jump right into this, guys. The NASDAQ is slightly up today, almost 1%. Over the last 1 month, it's almost down 5%. So we've had a pullback in the Qs. The last 6 months, it's 15%. Year to date, up 13%. And the SPY is pretty similar. Not going to lie. The SPY is right around break even for the month, actually. So it's been holding up better because we've been seeing more rotation into stocks that haven't been getting a lot of love. And we've obviously know that semiconductors and memory have just been running like crazy. And that's been the leaders of this entire market. So now we're seeing those sell off and starting to, make sure I didn't mute myself, starting to rotate into other sectors, financials, healthcare, some SaaS software companies. Who else? We're also seeing some rotation into biotech. We're seeing this rotation, which it's good and healthy. Also consumer staples like Elf and Nike. We're starting to see this rotation. It's very good for any bull market to see rotation. But if we hop over here to the charts, I'm not liking what I'm seeing. And you might be able to spot it right away because I made it pretty simple with all the arrows. So real quick, give you the rundown. This is the Williams percentage range. This is a momentum indicator. This is my matrix indicator. My matrix indicator tells us when there's a bear trigger, means stocks should continue to go lower. It means there's been a flip from bullish to bearish. And then you have a bull trigger, which means there was a flip from bearish to bullish. And obviously it looks kind of like a MACD. It's not the MACD, but I have it set up to where it kind of is simple to read and understand like the MACD. And then down here is what I call the sweet spot. We want to see the stock, or we want to see the indicator come down here and then move up and out. That lets us know, hey, the correction is almost over. Once we start moving up and out, the correction's over. We are going on our next bull run at this time. And then we have the red and green lines. That is simply a bear trend and a bull trend. Very, very simple. It's like moving averages, but I have it set up to where this leading indicator turns red whenever things start getting dicey. So you see we had a bear trigger. We had a green to red leading trend indicator. And then we had a full flip of bullish trend to bearish trend after consolidation. Then we had our correction here. Same thing here. It warned us here, bear trigger here, consolidated, then we had the correction. And right now we're seeing the same thing today. Bear trigger, a bearish leading trend line from green to red. And then next thing we need is just a bearish cross to go from a bull trend to a bear trend. And make no mistake, this gap might get filled all the way down here to, let's call it 640 to 600, 600 to 640 on the Qs. If we do get that bear trend flip from a bull trend and we see this big move down. Now, this is where the Williams percentage range comes in really nice. So up here, the red barrier is basically your resistance. And then down here, your green barrier is your support. Markets flow up and to the right over time. Markets do not flow down and to the left, down and to the right over time. Markets are not inherently averaging down, they're averaging up over the long run. So obviously we can understand that we're going to spend way less time down here at the green barrier where we bounce and we're oversold than we would up here at the red barrier. Obviously we're going to spend more time up at the red barrier because above negative 50 is bullish, below negative 50 is bearish. Okay. So obviously we are spending more time in the bullish zone than the bearish zone. Again, because markets trend up and to the right over the long run. Okay. Now that we know that, these are Williams consolidation boxes. These are basically just telling us, hey, we ran up to the red barrier, we pulled back. And as long as we stay in this box, we're going to run up and to the right. Stay in the box, run up and to the right. Stay in the box, run up and to the right. And once we break down out of that box, that's where things get dicey because as we see, there was a move higher, but that was just a fake out before we actually got the correction. And we would have known that because we got a bear trigger and we had a leading indicator or a leading trend line that was red. So we wouldn't have got faked out by this Williams percentage range saying, nope, everything's okay. No. We have a bear trigger and we have a leading red trend line. Same thing here. We broke down out of the box and we had a snapback. Then we had all this consolidation. Then we had the correction with the Iran war. Look, bear trigger in the lead trend of the bullish or the lead trend line went from green to red, telling us warning, warning, warning. So now that we got all that out of the way, we can obviously see that we are having a breakdown of the Williams consolidation box. We are having a bear trigger. We are having a bearish red lead line. And on the matrix, obviously right here, we are having a bearish flip from bullish to bearish of the zero line and a crossover of our matrix lead and lagging line, which gives us a bear trigger, which tells me things do not look good right now and the markets might be cooked. Okay, now that we got that out of the way, this is what I teach my High Five Collective trading community. If you want access to High Five trading community, whether for investing, trading, all my trade alerts, or to get my access to my bull and bear trends, get access to my matrix indicator, which is for the bull and bear triggers, and my matrix targets, which gives you invalidation zones and 3 targets higher or lower based on the trend. You can get all access to that. I'll leave that link down in the bio below. While you're down there, hit the like button and subscribe so you don't miss any future videos. So what I teach in my trading collective and what I consistently do. Everybody always says the same thing. Everyone's a genius in a bull run. Everyone's a genius in a bull market. I say good. Good. That should make it way easier on all of us. If I'm a genius here, and I'm a genius here, and I'm trading with 100% of my trading capital, and then I'm sitting there saying, I'm not a genius here, I'm not a genius here, and I'm not a genius here, because we're in choppy conditions, and then I'll short some here, I'll short some here, and I'll short some if we get this move down here. I'll short a little bit, but overall markets go up and to the right. So shorting is a losing game inherently. So I'm not going to be doing too much. Basically, when we get these choppy periods like this, or when we get these downtrend corrections, I'll either short a little bit in the downtrend corrections, but overall, I'm going from 100% trading capital down to about between 20 and 40% of my trading capital I'm actually using. And I'm looking for more short-term, like daily or weekly swings. Not this like, let me look at a weekly trend and go for like weekly or monthly moves with momentum. Because I'd rather be a genius and make all my money here in the bull runs, in the bull markets, than try to be a genius when it's really, really difficult. Really difficult. When we're in these choppy time frames, like we are right now, like we have been in 2026 beginning, and like we're in early 2025, good luck. Good luck. You could be the best trader out there. It is very, very difficult to be consistently profitable in times of chop like this, because 2 weeks you're up, 1 week you're down, you gave back all the gains you just had. 2 weeks you're up, 1 week you're down and gave back all the gains that you just had. Same thing vice versa. 2 weeks you're down. If you were shorting, then guess what? It turned around and gave back all the gains that you just had. It's very difficult, guys. It's very difficult. And then again, shorting, you could short some, but you shouldn't be shorting a ton, because shorting is obviously very difficult inherently because the markets go up and to the right, obviously. So that's what I teach. We make money in the good times because we're geniuses then, and we avoid giving all our money back and losing all of our gains and creating losses, unrealized or realized, for the year. That's not how you be a full-time trader. This is how I'm able to be a full-time trader, understanding that I'm not a genius. I'm not a genius. Only when the market makes it so easy to be a genius am I. But I'm not a genius enough here and possibly here to outmaneuver the markets, because algorithms are crazy. So what does that mean? Well, getting back into what I'm seeing, we're seeing the same thing. Consolidation, Wyckoff distribution, correction. Consolidation, Wyckoff distribution, correction. Consolidation, Wyckoff distribution, possible correction. That's where I lean. Why do I lean that way? Because here, Williams consolidation broke down, had a fake out, then you had it. Williams consolidation box broke down, had a fake out, had chop, then you had it. Correction, correction. Here, Williams consolidation box broke down, you're below -50. Could you snap back? Sure. But guess what? Get all this out of the way. I think it would be a fake out, because you got a bear trigger and you have a bearish trend. You have a bearish leading trend line. You have a bear trigger. You have a bearish move down. You have a bearish Williams consolidation box. So it's leaning towards that we continue to go down. Next, adding 2 more indicators. RSI obviously has been trending down, looks bearish. And then our temperature rate here. This is a great indicator that we have as well. So basically, we just close this out, move that up. When you're below the zero line, guess what? You're most likely getting a correction. When you're above the zero line, guess what? You are on a bull run. When you go back below the zero line, you're chopping and then correction. When you're above the zero line, you're bullish, you're going higher, things are looking good, but guess what? Now we're flipping red. Now we're cruising down to flip over the bullish temperature to a bearish temperature. And if that happens, then again, we probably see somewhere down here between 600 and 640 to retest this chop down here on the Qs. And it just doesn't look good. What else do we got? We got the options market over here on Voltic. If you want 20% off on Voltic, you can go down in the bio below, click my link. You can go get access to options flow. You can get access to JEX, VEX. You can get access to dealer positioning. It's really good to understand where all the put walls are, the call walls are, where you're going to get support, where you're going to get resistance, and then overall the volts. And you can have scanners on all this stuff as well. And I've been using this, and it's been doing very well. Very well in our small account options challenge. Has been doing very, very well. We took about $12,000 into about almost $24,000 at this time, almost doubled it in 3 months. It's been pretty crazy. It's not just as easy as like, oh, there's a volt, let me just do this, right? It's that, and then combining it with our trading knowledge and what we have access to with our indicators. But where are we seeing? So with volts are basically like magnets. So think of it like there's mostly positioning down here at 680 and the price at 700. So basically think of it like a magnet trying to pull price down to 680. Okay. So why does it not look great? Well, on the Qs for 1 month out, we're at 703. The magnet's pulling down to 680. The magnet's pulling down $22. $22 lower. Okay. So it's pulling down $22 lower. We don't love that. The SPY for September, we're at 746. The volt or the magnet's at 710. It's pulling down $36 lower. And then for IWM, Russell 2000, it's at 294 today. It's pulling down to 275. So the magnets are the dealers and the options market is saying lower over the next month or two. What we're seeing here with history repeating is saying lower. And just so you guys know, if you're a trader, you don't want this. You want to just get down to this green barrier as fast as possible. Because when we get down to this green barrier, guess what happens? Good things happen. When we get down to the green barrier, good things happen. That's where we bottom out. That's where we go in the next bull run. That's where we can all be geniuses and make money in the next bull market or bull trend higher. That's what it's all about. So options market saying lower. History looks like it's repeating, saying lower. Now, just so you know, we are still here in a bull trend because we are still green. We're starting to get a bear trigger, obviously. Starting to get a red bearish lead trend line. Things don't look good, but overall, this is holding. There is a chance that this holds and then we bounce and we go back higher. But again, it's just not looking great. We would need to get a new bull trigger to cancel out this bear trigger. And then we're also going to need this lead line to flip back to green. So again, make sure you like and subscribe and turn on the notification bell. I'll be keeping you guys up to date on what I'm seeing with the markets and what's happening with all this stuff, so you guys are in the know. Lastly, let's talk about the news. The news is not the greatest either. The news is lining up with the markets having a correction. Hedge funds are dumping U.S. stocks at a record pace, says the Kobayashi letter. Go give them a follow. They're always first to report any kind of news. Hedge funds have sold information technology stocks in 6 of the last 8 weeks. Not good, guys. Not good. And probably the worst one. This is the second worst one. The first worst one is that the U.S. lost two military members due to an Iranian strike in Jordan. My heart goes out to the families and to those lost souls. As a veteran, it's terrible. It's terrible. You know, we signed a dotted line to put our lives on the line, but you never think you're gonna have to cash in on that. But two people did have to cash in on that, and it's truly sad. It's sad. So my hearts go out to their families and them. It's gutting. So that's the first worst thing, and that's probably going to cause escalation, right? The second is that U.S. gas price officially rise back above $4 per gallon on average as the Iran war returns and the memorandum of understanding collapses. So a lot of things going on there. Escalations are rising again. Things are starting to not look good again. And obviously, guys, no one has to explain it to you. Basic economics. When gas prices go up, when oil becomes more expensive, inflation goes up because every single driver has to pay more. Every single company has to pay more to deliver things like Coca-Cola, right? If you want to get Coca-Cola to a grocery store now, the driver has to pay more in gas, meaning the companies have to pay more, and it always gets passed on to the consumer. So Coca-Cola is worth, you're going to have to spend more money on Coca-Cola, on eggs, on everything. If there's construction, they have to power these vehicles with more gas, and the gas is more expensive, so they're going to charge more money. Construction is everything's more expensive. That's how it goes. So at the end of the day, guys, if you're an investor, you want to get down to this green barrier, make sure you have some cash right now. Make sure you have between 15 and 30% cash right now in this market, and you're deploying it here and lower, because we might be getting some more great deals coming up based on what I'm seeing, and we want to make sure that we have cash. Now is not the time to have zero cash, in my opinion. We've had a small pullback, but things are looking bad, and they're looking like they're going to get a little worse here soon. So you want to have some cash. And if you're a trader, stop trying to be a genius in all this chop. It's not going to work. It's not going to work. Come on over, join the High Five Collective. Stop trying to be a genius at the wrong time and come be a genius at the right time. Let's make money together when it's easy, not when it's very difficult like right now. Love you all. Like and subscribe. I'll catch you guys in the next one.